day, ladies and gentlemen, and welcome to our webinar on risk management and dealing with risk and understanding how to use orders to manage risk, correlation risk, and stop losses and take profits. Now today we're going to start out talking about risk in general, because it should be the foremost thing on your mind whenever you are trading. Risk is an essential part of day-to-day trading. Without risking capital, you can't achieve any returns, but traders today have a suite of tools to help them control risk as they manage their positions. So what is risk trading? In trading, risk is the potential that your return from a trade may be lower than you expected. That could be because you had to close it beneath your profit target, or it can mean losing all of your capital you spent on the position. No trader gets every decision right. And look, I've been trading for a lot of years. And if I'm doing really good and really concentrating and really paying attention and spending the time doing what I should be doing, I will get 4 trades out of 10 successful. And a successful trade doesn't mean you necessarily made money. The trade did exactly as expected, worked as it was supposed to, and all the things you did and put in place were successful. Okay. Non-successful trades are trades that went against you, that you got stopped out and lost your money because you put the stops too close, you forced your risk-reward ratio, you did something. But if 4 trades out of 10 make me profit, whether it's sometimes small profit, sometimes it's larger, out of every 10 trades that I've used proper risk management, I've had small losses. But my 4 profitable trades, even though 1 and 2 were smaller profits, 3 was a bigger profit, 4 was a nice profit, when I net them out, I ended up out of my 10 trades with a positive result. Because not every trader will get everything right. So it's essential to develop a comprehensive plan for managing risk within your trading, especially when using leverage, which will amplify losses as well as your profits. Now, there are several different types of risk you have to be aware of. And a lot of newbie traders don't even realize that risk comes in different fashions and can attack you differently. One, we have market risk. Market risk is the possibility that your trade will earn less than you expected due to adverse movements in the market. It is the most common type of risk and the one that most traders do most work to mitigate. We all know what it is. One important step to control market risk is to understand the unique factors that will drive prices on the asset you trade. If you're buying stocks, for example, then you should learn the effects that interest rates, forex prices, might have on the companies you're investing in or trading. Some might be obvious, but others might be more obscure. Then there's liquidity risk, something nobody really thinks about. It doesn't happen too often, but when it does, you can lose your shirt. Just a few years ago, when the Swiss National Bank pulled the peg out of the Swissy, which had been in place for years, people around the world, brokers around the world, crashed. I can't tell you how many brokers actually went bankrupt. Okay, you couldn't get out of your trades, and what happened was you had a $1 million trade out there because you were using all the leverage possible, and the euro tanked, and your trade had lost hundreds of thousands of dollars, and the broker's on the hook for it till you pay it. And so many people just ignored the broker, told the broker to go away, whatever they did. And because the market was moving so fast, the stop losses weren't holding because you couldn't get out. On the other side, what happened when Russia invaded Ukraine? Oil prices shot up. So if you were sitting with short positions, you couldn't get out because the market was rising so fast. So these things happen quite often if you're trading cryptocurrencies. Whoa. So say you own some shares in XYZ company, a relatively unknown firm. The trade isn't delivering the returns you expected, so you want to exit the market. But you can't find someone who wants to purchase your stock. You may have to sell them at a loss to get them off your hands. Okay, now let's talk about it. If you're smalling trading, whether CFDs or stock trading, small cap stocks, small companies, they don't move off a lot, or there's not many shares to be bought or sold at the moment because there's not many sellers or buyers. So you may want to get out of the market, but you just can't. And then when something like you read the CEO was indicted for sexual misconduct and the share price starts tanking, it's such a little company that had so much potential, but you can't get out, and you can't get out even though you were in profit. You can't get out and you suffer a loss. So liquidity risk is less of an issue when trading CFDs or forex with a market maker. You never own the asset in your account, so you don't need to find a counterparty for each position. And then we all ignore basically entirely systematic risk. The final risk you should be aware of is systematic risk. This refers to a chance that an issue with a wider financial system will hurt your bottom line. Again, housing market crashes, the dollar tumbles, interest rates fall, and all of a sudden the stock market crashes. Okay. Systematic risk. Russia invades Ukraine. Stock market crashes. Dollar goes way up in value. Cross currencies fall way down because everybody's running to safe havens. So a classic example of systematic risk is a global market crash. Here, stocks and indices around the world tumble with subsequent impacts on other assets. Unlike market risk, the problems are widespread and systematic. Systematic risk can be tricky to mitigate against, but one common method is diversification. Spreading your trades across multiple asset classes and economies can help protect you if crash rises. However, you'll need to ensure that your research on each market has been done properly. Now, there's one way that if the markets are really crashing, that you can protect yourself. Your trade is crashing. You can't get out of it. Okay? You can enter a trade for a different asset that would be going the opposite direction or corresponding to that fall, just to offset, almost to hedge your loss. So sometimes it's just initiating a new trade based on what the current market conditions are, because we have what we call correlations and risk management. Financial markets rarely move entirely in isolation. A trend in one asset will often ripple across several others, meaning some prices rise and others fall. Haven't you ever noticed that Bitcoin is soaring up? Usually you find Ethereum and Dogecoin and all the others following it up. This effect is called market correlation. While it can be useful for spotting opportunities, it can also increase your risk if you aren't careful. But by understanding how correlation works, you can take a significant step towards lowering your overall risk. Market correlation is a measure of how much assets move in line with each other. You can measure the correlation of specific markets, industries, and entire asset classes. Correlation is usually measured as a percentage. If two markets are 100% correlated, then their movement will always be the same. When one rises, so will the other. And this is called the perfect correlation. Now, it's very rare to find perfect correlation, but we can find a correlation between, say, Brent crude, natural gas, and WTI crude. We can find a correlation between the euro and the Swiss franc, the Australian and the New Zealand dollar. So a 50% correlation, meanwhile, means that the two markets generally move in the same direction, but not always following each other in lockstep. Stocks in the same sector may show very high correlation rates. Google and Facebook, techie stocks. NASDAQ is up, the techie stocks are all up. It's very rare to find Facebook diving for any length of time, while Google and Amazon remain the opposite direction. Stocks in the same sector may show a very high correlation rate, which can make it difficult to find a share that outperforms its peers. Forex pairs are often thought as highly correlated, especially when they feature the US dollar. US dollar euro, US dollar Australian dollar, US dollar Japanese yen, US dollar Swiss franc. You can watch them on a chart go up and down, almost laying on top of each other. Correlation can have a significant impact on your overall risk level and your bottom line, chiefly because they act against diversification and can mean that one market moving against you impacts your entire portfolio. For example, if you have open short positions in two markets with a 75% positive correlation, then it is probable that a bear trend in one will lead to the same move in the other. In this case, you risk losing the capital allocated to both positions if one moves against you. Your total risk from the trade could be higher than you originally planned. If you have multiple correlated positions, then your overall risk on a portfolio level can be higher than you think. So it's always worth researching which markets are related and which can add to your diversification. I think the crux of everything I'm trying to tell you here is you need to develop a risk management plan. The key to controlling each type of risk you encounter is to develop a risk management plan, a comprehensive plan that will cover your exit strategy, position sizing, and how you pick opportunities. But before you enter any position, you should know exactly where your point of pain resides, the maximum loss you want and can afford. To risk any single position consistently, allowing losing trades to go beyond this point, is a recipe for failure. So considering entering stops on all your trades, you should never trade without the bare minimum risk tools. And we're going to discuss stops shortly because there's many different kinds of stops. Most traders don't know how to use them properly. Position sizing is also important. Another habit of many pro traders involves position sizing, which is where you decide how much capital you allocate to each opportunity ahead of time. And you know what? A lot of traders, they're trading the euro dollar, the euro Swiss franc, and the euro New Zealand dollar, and the euro pound. And even though each trade has got a maximum risk of $500, they don't realize those markets are correlated. So technically they're facing, if that market, the euro goes crazy one way or another, you're actually looking at a $2,000 automatic simultaneously loss. So instead of rushing into new position opportunities, you should weigh and consider things carefully. This means creating a detailed trading plan as part of your preparations and sticking to it. Stick-to-itness. Try to avoid entering into trades randomly and haphazardly based on emotion of excitement, greed, or fear. The fact that a market is rapidly moving in one direction or another may not constitute a rational reason for getting into a trade. Establish a detailed strategy for entering and exiting trades. A detailed strategy defines parameters for getting into and out of trades, so there's no ambiguity. Watch your downside risk and be prepared to act decisively. Make sure that you're disciplined enough in preserving your account so that you live to trade another day. Now, today we're not going to talk about all the different types of order entries, because order entries puts you entering the game is where your risk starts. Until you actually enter a trade, you've got no risk, you've got no potential profit, no potential loss, but you're sitting a sideline. So to enter the game, you need to know the different ways to enter. Okay, and it's very crucially important, but that's a whole class unto itself. But you should know market orders, limit orders, OCO, GTC, if orders, if and now orders. They're very important because they can create profit for you. But exit orders are like entry orders, but instead of automatically opening a position, use them to tell your broker or the trading platform to close a trade when the market hits a specific level. Like with entry orders, you can use exit orders as either stops or limits. Exit orders are pretty like entry orders, but instead of automatically opening a position, you use them to tell your broker to close the trade when the market hits a specific level. You'll often see limits referred to as take profit orders or stop loss orders. This describes what each does. Use limit orders to lock in a set amount of profit, while stops close a position if it incurs a certain level of loss. Well, take profit orders are kind of odd. I personally don't use them. Or if I do, I set them way higher than my expectation. In case the market surges and something pushes up for a second, I'll get some extra profit. But I'm constantly watching my orders. And if the market starts generating more volume and more momentum in my direction, I don't want to have my trade closed even though I close at profit. I may want to let it ride. Stop losses are protecting my risk, but there's many ways we can use stops. Okay. Now, understanding stops. Because stop is not just about exiting the market. It's not just about protecting your loss. Take profit orders are exit orders that you can automatically close a position if it reaches a specified price that is better than the underlying market current price. They can help you to be disciplined with your trading strategy and not chase profits unnecessarily. Now, everybody talks about chasing profits unnecessarily. But instead of closing your order with a take profit order, why not move your stop loss all the way up into profit and let the trade run? That way, if it reverses and falls down, you get stopped out way in profit. And for that, we also have something called trailing stop losses. So stop losses are exit orders that you can set automatically to close a position if it reaches a specified price that is worse than the underlying market's current price. Stop loss orders are an essential tool to help minimize your losses if a price moves against you. So now there are different types of stop losses. Okay, there's actually 3 different types. There's the guaranteed stop loss, the standard stop loss, and a trailing stop loss. Standard stop losses work in the way we've outlined above. Okay, you open a trade for X, Y, and Z stock at $100. Okay, you can only afford to let it fall down to 90, or when you've done your mathematics, your risk-reward ratio, and everything, you set 90 as your stop loss. That means if the stock falls below 90, it's going to close your position, sell at a $10 loss, and you'll take your loss. Your take profit order is, say you've evaluated that after some announcements today and some profit statements, it's going to go to 120. Well, you can set your take profit at 120. You're very happy. You entered at 100, moved to 120, you got your $20. So you were protected. But what happens if the market surges to 130, 140, 150? You don't want to be greedy. You don't want to say, if I would have, could have done. You made the profit you started out to get. But what if when the market surged and went to 120, you moved your stop loss up to 119? The market moved up to 124, 125, 126, 127. You move your stop loss up again farther to 122, 123. You're constantly, when the market turns against you, unless something really bizarre happens, you'll get out at when the market turns against you. But now you'll get out at 123. Now, guaranteed stops. Most CFD and forex brokers today, all their stops are guaranteed, except they don't charge extra for a guaranteed stop. But a guaranteed stop means if some type of market calamity happens, you are guaranteed to get out. But really with CFDs, you kind of always get out. But if the market gaps, sometimes you'll get out, but you'll get out at the bottom of that gap. Now, trailing stop losses. They are probably the most important risk management tool you can have, and the most neglected. Trailing stops follow your position as it earns you profit, helping protect profits without limiting them. Like standard stops, you set a trailing stop at a specific number of points from the current price of your trade. So, let's go back to our stock at $100. You didn't set your stop loss at 90. You set your stop loss at $10. So you told the computer if the stock falls below $10, but when the stock pushes up to 110, guess what? That stop loss moves up, stays $10 away. So it's now at 100. When the stock moves up to 120, it's moved up to 110. And you can also constantly define it and adjust it. So if the market continues to reverse, your stop loss will be triggered, closing your position and protecting any profits you made. Now, what I do, depending, each time I have different entries, I have different entry and exit strategies, always stating my stop loss, but depending on how the market is moving based on, first I look at price action and I can make assumptions about how the market, but if the market's doing better than I thought it would be, okay, and I get up to my target point, I'll move my stop loss and I'll close half of my position. So say I had 1,000 shares of X, Y, and Z company at 100. I thought it was going to go up to 120. Okay. So when it goes up to 120, I move my trailing stop loss up, say 117, 118, and I also sell half of those shares. I've got the profit in my account. I've got only half of my investment left, and it's already guaranteed in profit. If the market moves up a little bit higher, I move my stop off a little higher, and I might sell off or close off a half of that, and then I'll let the other one ride as far as it goes up. And I'm constantly locking in profit and putting money in my account. Okay. But it means that I have my three-pronged strategy is one of my set exit strategies. So a trailing stop loss is probably the best to use at all times, and you should learn to master it. But you should learn never to trade without a plan. Your plan should include your risk management and exit strategies. Because remember, risk, risk, risk. Manage your risk. So that's it for today. And please come back and learn all the different types of order entries. And we'll teach you how to set up your trade and pick the right order to get you successful. Thanks.